In this video, we'll explore the use of options for trading and hedging. Trading strategies generally fall into three main categories known as spreads, straddles, and strangles. You can think of spreads as a way to combine different options on the same underlying asset. These options are usually of the same type, meaning they are either both calls or both puts, but they have different strike prices or expiry dates. A key benefit of spreads is that they are limited profit and limited loss positions, which means your risk is strictly managed. We mainly categorize these into vertical, horizontal, and diagonal spreads. Now, let us look specifically at vertical spreads. These are created by using options that have the same expiry date but different strike prices. We can construct these using either a combination of call options or a combination of put options. Depending on your view of the market, whether you think it will go up or down, we classify these as bullish vertical spreads or bearish vertical spreads. This gives us 4 specific ways to trade based on our market outlook. Let us dive into the bullish vertical spread using call options. We use this strategy when we have a positive or bullish view of the market but want to lower the cost of our trade. You do this by going long on a call with a lower strike price and going short on a call with a higher strike price. For example, if you go long on a 17,500 call with a premium of 185 and go short on a 17,800 call with a premium of 61, your net premium paid is 124. In this case, your maximum profit is a profit of 176 and your maximum loss is a loss of 124. You reach your break-even point when the index is at 17,624. In a similar way, we can create a bullish vertical spread using put options. This is known as a net premium receipt strategy because you receive money upfront. To set this up, you go short on a higher strike put and go long on a lower strike put for protection. For instance, if you go short on a 17,500 put with a premium of 125 and go long on a 17,000 put with a premium of 34, you receive a net premium of 91. Here, your maximum profit is a profit of 91, while your maximum loss is capped at a loss of 409. The break-even point for this trade is 17,409. If your view of the market is negative, you might consider a bearish vertical spread using calls. This strategy is designed to prevent the unlimited losses you might face with a regular short call while still earning a premium. You sell a lower strike call and buy a higher strike call as insurance. For example, by selling a 17,500 call and buying a 17,800 call with premiums of 185 and 61 respectively, you get a net inflow of 124. This inflow is your maximum profit. However, if the market rises unexpectedly, your maximum loss is limited to a loss of 176 with a break-even point at 17,624. Another way to trade a falling market is through a bearish vertical spread using put options. In this case, you go long on a higher strike put and go short on a lower strike put to help pay for the first one. Let's say you buy a 17,500 put for a premium of 125 and sell a 17,000 put for a premium of 34. This results in a net cost of 91. If the market drops significantly, you could see a maximum profit of 409, but if the market moves against you and rises, your risk is limited to a loss of 91. Your break-even point for this setup is 17,409. Moving beyond vertical spreads, we have horizontal and diagonal spreads. A horizontal spread, also known as a time or calendar spread, involves options of the same type and strike price, but with different expiry dates. You are essentially betting on whether the difference in time value between the two options will shrink or grow. On the other hand, a diagonal spread is more complicated. It uses options on the same asset but with different expiry dates and different strike prices. Because these involve different maturities, they are harder to execute and are more common in specialized over-the-counter markets. Next, we will look at straddles. This strategy uses two different types of options, a call and a put, with the same strike price and the same maturity. In a long straddle, you buy both the call and the put. For example, if a stock is at 6,000 and you buy both options for a total premium of 393, your maximum loss is that loss of 393. This happens if the price stays exactly at 6,000. However, if the price moves sharply in either direction, say to 5,000 or 7,000, you can earn a profit of 607. Your break-even points are 5,607 and 6,393. The opposite of that is the short straddle. You use this when you believe the market will remain very stable and won't move much. By selling both a call and a put at the same strike price, you collect the premium as income. In our 6,000 strike example, you would receive a net inflow of 393, which is your maximum reward. But you must be careful, as a big move in either direction can lead to unlimited losses. If the price swings to 5,000 or 7,000, you would face a loss of 607. This strategy requires a very calm market to be successful. Now, let us discuss strangles, which are similar to straddles but use different strike prices. Specifically, a long strangle is built using out-of-the-money options, which makes it cheaper to set up. For instance, you might buy a 6,200 strike call and a 60,000 strike put. If the total cost is 285, that is your maximum loss. You will only start to profit if the price moves significantly beyond your break-even points of 5,715 or 6,485. If the price reaches 7,100 or 5,100, you could see a profit of 615. Following that logic, a short strangle involves selling those same out-of-the-money options. Your outlook here is that the underlying price will stay within a stable range. By selling a 6,200 call and a 60,000 put, you earn a maximum profit of 285 if the price stays between those two strikes. However, just like the short straddle, your potential loss is unlimited if the market rallies or crashes beyond the break-even points of 5,715 and 6,485. It is a way to collect income, but with significant risk if volatility increases. If you are an investor looking to generate extra income from stocks you already own, the covered call is a great tool. You hold your stock and sell a call option against it. This helps reduce your overall cost of owning the stock. For example, if you own a stock at 1,590 and sell a 1,600 strike call for a premium of 10, you are effectively creating what is known as a synthetic short put. If the price stays below 1,600, you keep the premium. If it rises to 1,600 or more, your profit is capped at 20. This strategy gives you some protection through the premium, though your upside is limited. Building on the covered call, we have the collar strategy. This is an extension designed to strictly limit your downside risk. You own the stock and sell a call, but you also buy a put option to act as a floor for the price. Imagine you own the stock at 1,590, sold a 1,600 call for 10, and bought a 1,580 put for 7. If the price crashes to 1,490, your loss is capped at a loss of 7. If the price rises to 1,690, your profit is capped at 13. It is a very disciplined way to protect your investment. Another advanced strategy is the butterfly spread, which you can think of as a safer version of a short straddle. To avoid the unlimited risk of a straddle, you add two more options to limit the downside. Using call options, you would buy one call at 6,000, sell two calls at 6,100 and buy one more call at 6,200. If this costs you 30, that is your maximum loss. Your best case scenario is the price landing exactly at 6,100, giving you a maximum profit of 70. If the price moves too far in either direction, your loss stays at 30. Finally, we will look at hedging with options, specifically the protective put. This is like buying insurance for your portfolio. If you own a stock and are worried about a market fall, you buy a put option. For example, if you buy a stock at 1,600 and also buy a 1,600 strike, put for a premium of 20, you have created a synthetic long call. If the price falls to 1,530, your loss is strictly limited to a loss of 20. But if the price rises to 1,660, you still enjoy a profit of 40. This ensures you are protected from a crash while still being able to profit if the market goes up.